Welcome to Section 2 of Module 5 on Global Purchasing. We're going to dedicate 2 slides to the relationship between global purchasing and a concept that we've introduced previously, the 10 rights of importing. As we have discussed in prior modules and sections, the 10 rights of importing are dependent upon the integration of all supply chain activities, both internally and externally. That is a fact. What we're going to talk about here is the specific role that purchasing plays in influencing or directly impacting those 10 rights of importing. First and foremost, the right product. This has a lot to do with sourcing, but certainly purchasing as well, because if we're not procuring products that customers want to buy, the whole exercise becomes a waste. That is painfully obvious, but it's important to be explicit. Second, right place. This variable in our equation has a lot to do with cumulative lead times, as we spoke of just a moment ago in Section 1. Having the right product is one thing. We need to have it in the right place so customers can buy it. As we will discuss in greater detail, cumulative lead time and another very important concept known as lead time offsetting really drives the whole idea of purchasing having the right product in the right place at the right time, as we see in our third bullet point. But for now, let's tie in this idea of lead time offsetting by saying that we need to determine what the cumulative lead time of a product is and place orders at a point in time that we can account for all of that cumulative lead time and get it to the right place at the right time, precisely when we need it. That sounds easy conceptually, not easy at all from an execution perspective. In fact, it's probably one of the biggest challenges that any supply chain has. This is especially evident in seasonal businesses like retail, where things like back to school, holiday season, different fashion seasons really matter. We're going to dedicate a lot of time to translating these easily understood concepts into executable tactics. Right quantity. This takes us all the way back up the supply chain to forecasting, as well as identifying real demand signals in the supply chain. It's great to identify the right product. We know we have something customers want to buy. We're reasonably good at getting it to the right place at the right time, but if we don't have enough, or if we don't have too much, obviously a whole other set of problems. We're going to address this issue in a section that talks about order quantities, order points, min-max systems, and most importantly, material requirements planning, because essentially material requirements planning is all about quantities and timing. Quantities and timing. You will hear us say this over and over again in this module because it's so important. Purchasing is about the right quantities at the right time. Last bullet on this slide, the right condition. This ties us into relationships with the actual vendors and all of the parties across the inbound supply chain that physically handle our goods. Here, we're talking about the right packaging, of course, the right SKU mix, but also the physical condition of the goods. Retail ready, as it sometimes is called. With the packaging 100% perfect, no damage, no crushed cartons, no water damage. That's what we're talking about, right condition. One of the greatest expenses that any supply chain can experience is damaged goods, whether it's inbound, as we're talking about here in a purchasing environment, or outbound in the sell side of the supply chain. Keeping goods in the right condition and the expense with having them not in the right condition can be very high. We'll talk more about that later on also. Right cost ties us right into the financial relationship between sourcing, purchasing, and accounting. We've already said in this module that purchasing is tied directly to landed cost. We know that, so we have to negotiate the right price in a sourcing/purchasing environment, but watch all of the other costs as well. Origin drayage, international transportation, be it ocean freight, air freight, truck, rail, customs duties, additional customs-related fees, domestic transportation. That's what we mean by right cost. Because as we know, to a very real extent, the landed cost of an item is going to drive our pricing, in part, and ultimately our profitability. This is why the first 2 bullets in this slide are right cost to us as the importer, so we can sell our goods at the right price. What's the right price? Well, if we go back to Economics 101, it's whatever price the market will bear. That's an important consideration. But if the market will only bear, say, $50 for the price of a given item, and our cost is $45, is it really the right price? It's definitely not the right cost, so we have to watch both of them. Third bullet, a little more nebulous, but we need the right visibility on the purchasing side of the supply chain. The sell side too, but we're here to talk about purchasing. We need visibility, starting with forecasting and demand signals. When that forecast and demand signals are converted into purchase orders and placed on a vendor, we need the electronic visibility into the status of those purchase orders from the moment a vendor receives and accepts a purchase order until we receive the goods. We're going to talk a lot about supply chain technology and visibility in upcoming sections in this module, so sit tight. This is an important one. Right delivery out to the customer, when the customer wants it, in the quantity that they want it. And then, of course, the right customer service, the overall impression that our customers have of us that will be clearly influenced by the purchasing activities that they'll never see, but that certainly influence their experience and the customer service that we're able to provide them. Let's move on. This ought to be a familiar slide as well. We do like to repeat them after all, but we're talking here about financial objectives, but global purchasing's role in achieving those financial objectives. This is a simple but very powerful slide because it forces us as tacticians, as purchasing professionals, as logisticians, as sourcing professionals, and certainly accounting people, to not only be cognizant of the financial ramifications of our activities, but influence them tactically out in the field by the things that we do, by the quantities and timing of the purchases that we make. First, seesaw, the goal of any organization. We saw this in our 4 objectives repeatedly. We want to maximize not only sales, but profits too, the right cost and the right price, as we spoke of a moment ago. However, in order to do that, we have to acquire inventory, and inventory represents oftentimes the greatest investment that any company can make, tying up money in inventory. So the balancing act here is to always have enough inventory on hand to meet our sales objectives, but never have too much. It's almost like that Goldilocks principle. We don't want our porridge to be too hot. We don't want our porridge to be just too cold. We want it just right. That is very difficult to do. With that said, this first seesaw is the essence of supply chain management from a financial perspective. If we look at our second bullet point, and we'll talk a little bit more about this in just a second, but the relationship between sales and profits in our first seesaw and what goes on in our second little seesaw here is with the income statement. Why is that? Because our sales figures appear on the income statement, but so do our costs in the form of cost of goods sold. Cost of goods sold for an omni-channel seller of finished goods that are imported from overseas. The cost of goods sold is the bundling, the total aggregation of the landed costs of every single product that we sell. Right away on the income statement. Sales on line 1. Returns on line 2 of that income statement. What's on line 3? Cost of goods sold. Subtract cost of goods sold from net sales, that's gross profit. All of that is on the income statement. Conversely, right side of our second seesaw. Why the balance sheet? Because inventory values, the inventories that we purchase internationally, appear on the balance sheet. And when we have too much money tied up in inventory, that creates a big problem. Why is that? Because it will negatively impact what we see in the middle of our second seesaw, cash flow from operating activities. Declaring a profit is one thing on the income statement. Having the cash around that is a reflection of declaring that profit is a different story. When we use too much money to invest in inventory and we can't sell it, we have the value of that inventory on our balance sheet, but that doesn't translate into cash. Financially, we want to focus on the middle here, cash flow from operating activities, which in turn is directly impacted by the income statement, landed cost, cost of goods sold, sales, and the balance sheet, inventory values. That's why this is portrayed as a seesaw, to create a balance between the two. If we as purchasing professionals, logisticians, sourcing people, and certainly accounting people don't have this in mind as we go through the integration of our overall purchasing activities, we're going to get caught in a problem financially. We don't have to be the financial professionals as purchasing people. What we do need to do is be aware of the ramifications, the financial ramifications of our activities, and always have them at the forefront of our thoughts. Portraying this whole idea in a different way, with the title, Global Purchasing's Role in Achieving Financial Objectives. We said this already a bunch of times. We're just looking at it in a different visual way. Here's our 4 objectives on the left. No need to go through them again. Here on the right are the financial reports that we spoke of in some detail just a moment ago. To reiterate, the income statement, that's where unit-specific, product-specific landed costs are all bundled together, added up, and portrayed as cost of goods sold. As we also said, the income statement is what houses sales figures, how much we sell in our stores, online, through our sales staff, through catalogs, etc. All of that comes together as sales. We deduct product returns from sales to get net sales. We take net sales and subtract cost of goods sold, which again is the accumulation of all of our products' landed costs to get to gross profit. On the balance sheet, inventory values are always shown on the balance sheet as a current asset. And oftentimes, especially for companies that outsource production and sell finished goods through an omni-channel distribution scheme, the biggest value they have on the balance sheet, hopefully, other than cash, is the inventory value. It's that balancing act. And the cash flow statement, without getting too deep into the financial side of things, is a reflection of what goes on not only in the income statement, but also on the balance sheet, because it's about cash flow. And inventory sitting on a balance sheet, but more importantly, sitting in a warehouse somewhere or sitting on the water in ocean containers coming in from Europe or Asia or where have you, really doesn't help our cash flow very much. Think about that balancing act and how purchasing impacts that. We've seen this slide before too. We're going to see it again. Many people believe, and this instructor would not argue the point, that supply chain management, in the end, it's all about inventory management, acquiring and selling goods, buy side, sell side, and creating a balance between sales figures and what we have to carry in inventory to achieve those sales figures. The question for us becomes, what role does purchasing play in an environment where we have conflicting goals? In purchasing, certainly congruent with a sourcing strategy, we want to buy in large quantities. We want to make big purchases. We don't want to deal with a zillion purchase orders in the course of a year. We want to deal with fewer purchase orders because they're easier to administer. When we buy in bigger quantities, we get bigger discounts, and we can decide between whether we want to work with multiple suppliers or fewer suppliers. Sales, they want everything. Total availability of product, no matter what, where, how, when, and why, available in any quantity, in huge varieties. When sales requests, which are a reflection of customer needs, create bloated inventories in the form of multiple SKUs, multiple packaging configurations, product spread all over the world in close proximity to customers, that's a problem, but it's also in conflict with other functional areas. Let's look at manufacturing. They want to produce in large lots with infrequent setups and less variety. That's if we're an in-house manufacturer, and oftentimes if we're dealing with overseas vendors that manufacture on our behalf. They want to produce in large lots. That's why overseas vendors that sell to U.S. importers have MOQs, minimum order quantities. So there's a conflict there too. And then finally, in finance, they want low costs, higher revenues, improved return on assets, and in the end, higher return on investment, which by definition, by the way, is tied very closely to cash flow from operating activities, which we've spoke of a couple of times now. Our job as purchasing professionals is to meet the needs of the organization while minimizing conflict, but keeping a close eye on landed costs, on cumulative lead times, on the coordination with multiple vendors around the world. That's not so easy to do. We're going to figure out how to make it a little bit easier. That's it for section 2. When we come back, we'll get into the details of global purchasing, starting with the functional responsibilities and the actual activities that purchasing professionals engage in.